Thank you guys for reminding. All right, perfect. Okay, any questions in the rules for strike selection, expiry selection, and process, the exercise and assignment process? Nine, 10. In case of a put option, the option seller will be required. So when you sell an option, when you buy a put option, what is it? Obligation, right to buy or right to sell? Right to sell. So if the buyer has right to sell, the seller will have obligation to buy, isn't it? Obligation to buy the underlying scrip at the required strike price. So if the option seller did not have those stocks, he would be short the scrip. Sorry, he would be long the underlying scrip, and if he was short the scrip prior to the assignment, he would be flat. That's it. It's just an understanding of how this works. The confusion is strike price and CMP. Why? What is the confusion between strike price and CMP? Ramesh ji? Flat means if you are short, that means you have a position, right? Short and plus then buy, that will become squared off kind of thing. Flat. I have not yet taught you that, Ramesh ji. Strike price अभी बताना है तुमको. Strike prices, exchange releases. The exchange releases the strike prices. Remember that. Correct, Arun. All right. Okay. And number 10 is, this is simple, right? This is that thing. Yes, Ramesh ji. The strike prices are released by the exchange, no one else. And then we have to choose in those strike prices. So there is a set of strike prices, and to choose those set of strike prices, we have certain rules. Now, at demand zone, you can either be a call buyer or be a put seller, or at supply zone, you can be a put buyer or a call seller. Now, both are correct. Both these positions are bullish positions. Both these positions are bearish positions, and you can use either of them. But the decision to either buy a call or sell a put at demand, or sell a call and buy a put at supply, is not arbitrary. It depends on the current price versus market conditions. All right, and that we are going to learn as we go ahead. Clear, everyone? All right, perfect. Okay. Now calls. Now let's say when you buy a call option, let's take the example of 100 call option that you buy. 100 call option then you buy at a price of 10 rupees. Okay. When will your profit actually start? Or let's say 100 call option at 5 rupees. That's the thing. Yeah. So at 100, after the price goes beyond 105 is when you start making your profits, isn't it? Because the first 5 rupees is what you have already paid. So that comes back to you. That's the cost of owning the right. Got it, everyone? So only when the stock goes beyond 105 is when you will start making money. Yeah. So 105.1 means 10 paise in profit. 106 means 1 rupee in profit. 108 means 3 rupees in profit. Correct. So that's why. So in case of call options, your break-even price. What is break-even price where you don't have profit or no loss? No profit, no loss. So the break-even price in case of call options are going to be the strike price plus the premium that you have paid. This is universal and this is irrespective whether you are longer call option or a shorter call option. Again, I am telling, please pay careful attention to this statement. The call option break-even price. So whether your position is short call or long call, doesn't matter. The break even for a call option is always going to be strike price plus the premium that you pay. Clear? And in case of puts, it's strike price minus premium. All right. For example, if you buy a 200 put option for a particular script at a price of 10 rupees, when will you start seeing profits? 190. So till 190 you are recovering all the premium that you paid, and beyond 190, below 190 is when you will start making your profits. Perfect. Now this is a important piece of information. Now, when you're trading options, right, you don't have to do all these calculations manually. The system, the software that we're going to use will give us all this information automatically. The only thing that you have to do is select the strategy, choose your strikes and expiry, and everything gets, all the summary information is provided to you based on that. Now let's go to the next topic, that is position graph. What are position graphs? Position graphs represent the profitability of an option's position at expiry. What will happen to my position at expiry? Okay, so this graph helps us understand how does the options play work out with time passing or at expiry or at different points in time at different stock prices. What happens to the stock? Okay, they help us understand the behavior of an options play to identify unusual characteristics. Prasanna, did you not listen to what I said? Can anybody answer this question for Prasanna? Let me see how many of you paid attention. No, Sony, you don't type. Break even point. Remember, Prasanna, short call or a long call is your position, is your decision. Okay? It is your decision. Yes, Bhavya, you're absolutely correct. Buying a call or selling a call is your decision, but the inherent characteristic of an options for a call option, that is the break even, is strike price plus premium, will never change. If you are short a call or if you're long a call, it will still remain the same. All right. Similarly, for put options, it is always going to be strike price minus premium. Remember, short call or long call is your decision, is your view based on which you have taken it. Okay, perfect. Correct, Anil. Everyone understood this? Okay. I have not yet started position graph, Chandrasekhar. Now, position graph represents the profitability of an options position expiry. So, whatever you see for the options, right, the strategy, everything is graphically represented to you. So, which will help you understand the unusual characteristics easily just by looking at it. The positions graph help us understand the behavior of an options play and to identify unusual characteristics. We know that there is no time value at expiry. So that is the basic premise that we use to create this position graph. All right. Now they help us to visualize three key considerations. Three key considerations. The first one is, what is the maximum risk for my trade? Options trade. Guys, this is, I mean, you have to understand, you have to be a little mature enough to understand one thing. If you don't let me explain, how can I show you the real graph? I mean, why, how come you're making the same mistakes? If you keep making the same mistakes, right, you're not fit to be a trader. You might not like my statement, but this is what it is. I've already told you, when I'm explaining, do not disturb me with questions that are, you don't preempt stuff. Do you think I will not show you a live graph and only explain you these slides? Will that be justice to you? Why do you assume that I'm not going to teach it to you? You know, remember yesterday I said there is one virtue that a trader needs to have. What is that virtue? And you guys are extremely impatient, guys. I will not sugarcoat. I will straight away tell you what wrong you're doing. You might hate me for this, but this is how I am. So understand one thing, okay? Understand really one thing. I am here to make you a trader. Okay? And to make you a trader, you have to help me make you a trader. Okay? So now, you are not going to get any brownie points from me if you preempt the questions or answers. Okay? I'm not going to give you brownie points. In fact, you are going to get a beating from me. Yeah, virtual beating. Fatkas. All right. Just be patient. You have to, first of all, you have to have your faith in me and trust in me. You know, if you also will get a chance to tell me what I am when you take the survey. If you don't like my teaching, feel free to give me 1 rating out of 10. I have no problems. But only when I finish everything. Okay, so have patience. I will teach you each and everything. I will show you everything live. We are going to plan many trades. Everything in front of you. And seriously, 55 people in an online class is not easy to teach. You know, by end of day 5, my throat is going to be messed up completely. Okay, just have faith in me. Don't worry. I will teach you everything. Every single, I told you, right? Every single point. I have been teaching this class for the last 4 years. I have been recruited as a consultant to teach this class only. And I fairly do a good job. That's why I got nominated as the best options instructor worldwide. Okay. Thank you. थैंक यू मैं जस्ट आई टोल्ड यू राइट मेरा एक ही प्रॉब्लम है मेरा अगर फ्लो ब्रेक हुआ ना तो मैं भूल जाता हूँ अब मैं ये प्रॉब्लम को सॉल्व नहीं कर सकता अब समझ लो ये शिव जी की देन है मेरे लिए okay let's go ahead so it helps us a position graph helps us to visualize 3 key consideration what are those 3 key consideration the first one is maximum risk what is the maximum risk that I am going to have for this particular option trade the second one is what is the maximum reward and the third one is what is the break even point where I will have no profit, no loss, maximum profit, and my break even points. These are the 3 key things. Okay. Now, when long options, when you're buying options, be it a call option or be it a put option, net profit that you make is going to be the intrinsic value minus the premium paid. Now, why is it so? Why are we only looking at intrinsic value here to calculate the profit? Because at this is at expiry remember absolutely correct Suresh this is at expiry time value is always going to be 0 so whatever value an option has is only going to be your intrinsic value so that's why the net profit is whatever intrinsic value is there minus the premium paid so in this case the intrinsic value is nothing but the final premium at expiry isn't it Sushant, okay, let me help Sushant here. He's unable to do it. Thank you, Bhavya, for sharing the number. Okay. Now, so when long options, net profit is intrinsic value minus premium paid. At expiry, we know time value is 0. So whatever premium is there, everything is going to be intrinsic value. And when short options, net profit Because time value is 0, Pudupet. Isn't it? These two statements are at expiry. These graphs are at expiry. So at expiry, the basic rule is time value is always going to be 0. Okay. And when short options, your net profit is premium received minus intrinsic value. So when we sell options, what do we sell? In the money or out of the money? Out of the money. So out of the money generally does not have an intrinsic value. But what if that strike becomes in the money by expiry? Or slightly in the money by expiry? So then it will have some intrinsic value. So finally your net profit in short options is going to be whatever premium you collected when you sold the option minus the intrinsic value, if any. If no intrinsic value, the entire premium that you received is your profit. Are these statements clear? And remember, intrinsic value will always help the long options trader and hurt the short options trader, because when you are long an option, that is buy call or buy put, you want intrinsic value. You want as much as possible, because that is all you're going to be a profit, are going to add to your profit. Whereas in the case of short options, you do not want any intrinsic value. Intrinsic value will hurt your position. That's the statement in asterisk. Intrinsic value helps the long options trader but hurts the short options trader. Clear? Because as a short options trader, we want the option to become 0 and not have any value. Correct, Rahul. Correct. Absolutely right, Shashank. Clear? And you know, one of the things, the reason I want to complete theory and strategies fast is so that we can plan more trades. And when we are planning trades, right, that's when my practical experience will come out. Right now, I'm just teaching you theory. I can't tell you practical experience because it will confuse the theory. So once you understand the theory, then I will tell you what are the different tweaks that you should do to make sure your options trading is more profitable and fruitful. The practical will start either tomorrow afternoon, depending on whether we are able to finish all the theory, or day after tomorrow. That is all the strategies will start. Then that's when all real life, which strategies work well, which do not work well, what are the issues with such strategies, everything I will keep on telling you. And also what strategies have paid me under what conditions, everything I'll tell you, so that you have that information with you. All right. I'm not going to do it fast. I'm going to go at a pace where everybody, even the slowest learner, will understand in this class, irrespective. But for that to happen faster, right, then you have to limit your questions to relevant points. Okay, now let's see how you get intrinsic value. Ramesh, you remember intrinsic value is for a call option, the intrinsic value is nothing but the current market price minus strike price. Remember the 826.30 and 820 strike example? Okay, so yesterday's slides, somebody asked me those slides, so let me just show it to you. But definitely one thing is there, teaching has helped me build patience. Yes, it rubs in all. Do you remember this example, Ramesh ji? So this is how you calculate the intrinsic value. The call premium is 17 rupees 50 paise. Strike price is 820. Script price is 826.30. So do you have an advantage of holding this call option? Yes. How much is the advantage? So if I exercise my right to buy the script at 820 and sell that at the current market price, what is the profit that I'm going to get? 6 rupees 30 paise. Correct. Did you get that, Mr. Ramesh? Perfect. So that is what is the intrinsic value. And if this was a negative number, intrinsic value is going to be 0. Let's say if the script price was trading at 816.30, in that case, 820 call price will have no intrinsic value. Whatever premium is there is only as the time value. Perfect. Now let's go. Did you understand, Mr. Ramesh? Don't worry, Ramesh. I know you have to sit in the rocket and go to your native town. I remember your dialogue when I was there in Bangalore in your final speech. I also have the photograph when you're giving that speech. Thank you. All right. Now let's see. Now this is an example here right now to calculate this manually. And why? And in the only in this class I will give you examples to do this manually. So whenever, so if you see, you have quizzes which will start doing from today onwards, and those quizzes will have these graph construction, and that you have to do manually. And the reason why I want you to do manually, or you are supposed to do it manually, so that you understand the details of this graph clearly. All right. Now let's say our strategy is buy 150 call option at 4 rupees. Okay, buy a 50 call option. So what I'm going to do is I'm going to use this sheet to explain it to you. So the strategy is buy, or I would say long plus 50 call option. So plus sign denotes long. So that's the strategy. Everybody's clear with this? At 4 rupees. So you paid a premium of 4 rupees to buy a 50 call option. That's the strategy. All right. Now, what is your view when you're buying a call option? Bullish. Perfect. Right. Now, what are the risk reward characteristics? Or before that, let me just add this. Before that, hold on. Now, so what kind of trader are you? A debit trader or a credit trader? When you buy a 50 call option, debit trading, right? Because 4 rupees is what you paid from your account. Now, for a debit strategy, what is the RR characteristic? Limited risk and unlimited reward. Everybody's clear with this? For a debit strategy, when you pay premium, that is the maximum loss that you can have. So that's why limited risk to the amount of premium that you've paid, and unlimited reward. It moves from 50 rupees to, let's say, 150, you're going to have as much as it goes up, correct? Perfect. Now, what is the break even point? Remember, no, not 55, Karanjit. So break even price point for a call option is strike price plus the premium paid, because you paid 4 rupees. So only when the stock moves beyond 54. Why 59, Ashish? Okay, fine. I thought it was by mistake. So that is equal to 50 plus 4, and that makes it 54. This is 54. Clear up to this point? All right. So now we will create this table. Now this table is here. So do you want me to create the table or explain here? Whatever suits you. I think creating will help you easily. Okay. Well, I'll create the table and then we will go through this. So when you want to create the table, right, the first thing that you have to use is what is going to be my stock price at expiry. Let me do one thing. So stock price at expiry. The second column will be intrinsic value effect. What is going to be the effect of intrinsic value on my position? Okay. The third one is going to be whether you are in a debit trade or in a credit trade. And the fourth column is going to be the net P&L. Okay. Okay. Sorry. Now is it visible clearly? What I'll do is I'll make this bold also. Is it visible? Oh God. Some more bold. Now, is that clear? Okay, perfect. Okay, so let's say what, let me see whether they started. Okay, 65 onwards. 65, 60, 55, 50, 40, 45, and 40. Okay, now Debit credit. So is this a debit trade or a credit trade? Debit trade. Debit trade means money goes from your pocket. Yes, so that's why. And how much is that? You paid 4 rupees. So that's why minus. Minus because it's a debit trade. That's a constant figure, right? Wherever the stock goes, irrespective, you have paid 4 rupees for your trade. This is assumption price at expiry. This is the net debit at whenever you took the position. Okay. Now we have to fill in this column. This column is nothing but we know at expiry what is time value. 0. So whatever value of whatever premium is going to be there is going to be completely intrinsic value, correct? Perfect. Now when the stock has closed at a price of 65 on expiry, at expiry the stock has closed at a price of 65. We are talking about the 50 call option. Is 50 call option going to be in the money or out of the money at expiry when the stock is trading at 65? In the money. Absolutely correct. In the money by how much? 15. Perfect. Everybody is fine. 15 rupees. So is 15 rupees the intrinsic value? Rameshji, is 15 rupees the intrinsic value? Perfect. It's a stock price minus strike price. Now, you are long this option. Is this intrinsic value going to help you or hurt you? Help in sense whether it is going to be in your favor or against you. Help, right? Everyone is saying help. Perfect. So that's why we make it plus. Plus, when it is helping, it is going to be plus. And if it is hurting, it is going to be minus. Clear? The plus minus sign in intrinsic value. Here minus plus is depending on whether it's a debit or a credit. And here plus minus is dependent on whether it is helping your position or hurting your position. Now at 60, what is going to be my intrinsic value? 10. Help or hurt? Perfect. So plus 10. Similarly at 55, plus 5. 50, 0. 45, हाँ आ गए सब -5 डालने के लिए. अभी सवाल पूछो. Remember, intrinsic value can never be a negative number. So if you get it as negative strike price, current market price minus strike price, then it has to be taken as 0 only. Got it? और ये सब कुछ बताया है मैंने, बस ध्यान नहीं दे रहे हो. क्या चल रहा है मार्केट? Yeah, that becomes out of the money, Bhavya. 45 strike now becomes out of the money. Correct. So out of the money does not have any intrinsic value. Yeah. Similarly, 40, 0. Okay. That's it. Now just do the math here. Plus 15 minus 4, plus 11. Plus 10 minus 4, plus 6. Plus 1. 0. Minus 4. Minus 4. Now what is our break-even point, guys? 54? Break-even point is nothing but where we have no profit, no loss. So if you see, between 55 and 50, does our profitability change from profitability to break-even? Yes, you are right. Yep. Yes, because 50 and the strike is 50 and this is 50, so there is nothing, right? Yeah, I made it. I made it. I made the change. Thank you, guys. Yes, Anand, you're right. This one you're talking about, Anand? This one. I changed it. All right. So now you see how that this is where my profitability changes. So that the break even is going to be between 50 and 55. So it's 54. And now what does this show? If I have to, now isn't this unlimited reward, this portion? As the stock keeps on moving up, your profitability will keep on going up. And this, and as the stock keeps dropping down, your risk is limited to the amount of premium that you paid. So this is going to be limited risk. Correct? And that's where, so this is where your break even point is going to be. And when you draw this on the graph, now let me help, let me draw, plot all these points, or we'll just go to the slide so that we can save on time. So we got all these values. Understood how these values came? And then the only thing that you have to do is just plot the points. So on the left axis, you will have your PNL, and on this axis, so the vertical axis is going to be PNL, the horizontal axis is going to be your stock price at expiry. So keep on plotting. So this is the center line. If you see 0 is where your break even point is. Just keep on plotting the points. So how do you plot? At 65 I have a net PNL of 11. So at 65 my profitability, so this is the first point. At 60 it's 6. So at 60, let's say 60 is here, that's my second point. Similarly, break even is at 0, then minus 4, and then just connect the line. So this shows that this is limited risk, unlimited reward, and that's your break even point. Now, only in the class you'll have to keep on practicing this. After that, you will this graph will be thrown to us by the software. Okay, let me just do one thing. Let me help you by drawing the graph here itself. Okay. Yeah, those are just illustrations. So if I have to choose, let's say line. Okay, so this is your PNL. This is your stock price. Stock. Okay. And so this is going to be a value of 0. The problem is zero plus 2, sorry, plus 2 plus 4, 6, 8, 10. Similarly, minus 2, minus 4, minus 6. I'll put 12 also here. Okay, and then you just keep on. Okay, here I'll have to note. That's horrible. So these are the stock prices. Just keep on. So it's difficult for me to plot on this thing. So simply this is where our PNL is going to be 0 plus 2 plus 4 plus 6 plus 8 plus 10 plus 12 minus 2 minus 4 minus 6. These are your stock prices at expiry 40, 45, 50, 55, 60, 65, 70, and just keep on plotting those points and then draw this line. So this is your unlimited risk, unlimited reward, and that's your break even point. Is that clear, everyone? Any doubts? No, Karanjit, it does. In your PNL calculation, it does. So you will come to know that when we take the practical example, Karanjit. But we will always create the graph at expiry. Yes, Santosh, you can square off any time that you want. If you buy it right now, the next minute you can square it off. Yeah, 329 also you can do it, Suresh. All right, everyone clear? Rahul, what do you mean to see the max picture of risk? No, Suresh, everything in the system will do. You don't have to do anything manually. Only in the class we are trying to just to understand we are doing it manually. Otherwise, everything is system driven. You don't have to worry. Anand, credit का तुम करो. Let's see how much you have understood. Quiz में है. We'll review it tomorrow. All right. Should we go ahead now, guys? So today during lunch time, what I want you to do is complete the quiz because it will take hardly 20 minutes because that will help you completely. Yeah, the day two quiz that will help you completely focus on your knowledge about the concepts that has been taught to you yesterday and today. All right. The quiz will be online. So when you go to my education, my courses, and go to your whatever um, course strategy, professional options trader India online. So you will see this day 2 quiz. Okay, so you'll have to answer this quiz. That will help you. The only thing is in the quiz, I don't think there is any graph given. Okay, so that graph example I will give it to you before the end of the class. Okay, all right. Direction. Chandra, direction. The stock has to move fast. First we rely on direction to pay. Second we rely on liquidity का क्या संबंध है इसमें? अगर स्टॉक लिक्विड नहीं है, ऑप्शंस लिक्विड नहीं है तो वी डोंट डू इट. Liquidity means volume, रमेश जी. How to find liquid stocks? आ गए. Okay, एक काम करता हूँ मैं आपको सिलेबस दिखा देता हूँ. Okay. See, tomorrow there are slides. Parameters to assess liquidity. Requirements for a tradable option. Assumption mother of all goof ups. Assume करते हो कि ये कोई सिखाएगा नहीं तो अभी पूछ लो सवाल. मजा आता है मुझे भी. आप लोग देते हो मैं लेता हूँ. All right, don't worry guys, it's going to be there. Okay, सब कुछ है. So do you really, okay, let me do one thing. Okay, let me first show you all the topics, what all we are going to cover. I'll tell you. Okay, we are going to understand what volatility is, how to assess volatility. Okay, how to understand whether we have to be an options buyer or an option seller, and we will go all the way to the detail of that. How to find out which volatility section, what I'm going to do, how and why we are going to, and not only what we are going to do, why we are going to do, that is also going to be told to you, so that you understand it. And then how to read the options chain, how to calculate the average IV, how to look at the volatility analysis, and after that how to choose your strikes by looking at the options chain, how to choose how to do your RR calculations for debit strategies, credit strategies, single leg strategies, multi leg strategies, all those RR calculations. So this is what I'll show you. Everything भरोसा नहीं है, भरोसा दिलाता हूँ आपको. सो देखो सिखाते समय ये सब, these are all the examples, graph examples, zone examples, volatility analysis, and then the most important part is you're going to, all this sheet is going to be created in front of you. So whatever you see this, right, now everything will sound Greek to you. Long call, bull call, short call, bear call, short strangle, ICICI bull call example, HDFC Bank bull call example, Gale Iron Condor, optionable scripts, everything is going to be given to you. This is what we are going to create for this batch. Okay, how to do your position sizing in options. चलो अभी कुछ रह गया क्या आपका, बताइए. बस और कुछ चाहिए क्या आपको? Is anything that you think is all right? सर अभी तो फिलहाल आप लोग मेरा सर घुमा रहे हो, आप लोग का सर नहीं घूम रहा है. Now using options for long term wealth. Options are probably the most versatile instruments to hedge, invest, or speculate in the markets. They can be used for both long term wealth and short term income. So, this class is all about short term income. When I say short term income, means it's trading income from weekly income trades and monthly income trades. Okay, using options for long term wealth is covered in great detail in the Proactive Investor course, and we are not going to look at any what are these proactive investor strategies. So strategies like covered call, strategies like buying script at discounted values, strategies like free protection, by mimicking script 1:1, all those things will be covered in proactive investor. I guess if you are a solution buyer, proactive investor is a part of your solution, and you'll have to, after this class, the next obvious class will be proactive investor. All right, so these are some of the strategies, but we are not going to cover those. Did I miss out on some slides? I guess I missed out on some slides. Uh, so this is a topic that I missed out yesterday, which I'm going to cover today. Okay. So do you want a break right now? Because this will take about 20-25 minutes, half an hour. So let's take a 15 minutes break, come back, and then I'm going to, this is just simple examples how to trade. I mean, just a logical explanation, not in details, just a logical explanation. All right. So let's take a break for 15 minutes, come back, and then do it. Perfect. So do not exit the room, guys. Just be in the room. Yeah, 12 o'clock we'll be back. Or 5 minutes to 12 or 12. 12, 20 minutes break should be good enough, right? Or you want 15 minutes? Whatever you guys say. Have to buy 155 call option. The next example is buying puts or supply. You have to buy 155 call option. All right. All right. Considerations. All right. So let's see buying calls at demand as an example. What all do we need to see when we are looking at buying calls at an area of demand? The script is in an uptrend and in the larger time frame. That's a consideration. There is a quality demand zone. So this is the demand zone that is shown here. Let me is that's a demand zone from 160.75 to 158.35. All right. So this is a demand zone that has been that is in consideration. And once the stock drops down to this demand zone, we want to take a bullish position. Okay. We want to enter a bullish position. Is the statement clear? The problem statement. Now, one of the assumption here is general public is in calm mode. Now, what is calm mode and all? We will talk about that later. Right now, just assume that yeah, okay, general public is in calm mode. That is, there are no news coming around, and therefore options premiums are deflated. Deflated means the premiums are low. Okay, deflated means the premiums are low. That's the market condition. General public is in calm mode, that is there are no news, and options premium are deflated. How to find out deflation, inflation, we will cover that later on once we get to volatility analysis. Now we want to take this trade, but instead of buying the stock or the future, we want to make use of options. Okay, we want to make use of options here. So the action that we're going to take is we will buy a 155 call option when the script hits the demand zone at 160.75. When the script hits the demand zone at 160.75, what we will do is instead of buying a script or a futures contract, we will simply go and buy a 155 call option. Is that clear, everyone? Simple. And let's take a look at the logic. Okay. Now, how are calls correlated to the underlying? Again, I told you, Mr. Rameshji, not to ask me why 155. That will come later on. I'll explain it to you, the rules. Right now, just take it from me that, okay, we have to buy 155 call option. Okay. So, they're positively correlated. So, which means the script goes up, call option will go up. Script goes down, the call option premium will also go down. Correct? So when the stock is currently trading at about 165 rupees, when the stock drops down to 160.75, what is going to happen to the call option? Is it going to move up in value or move down in value? Reduce. Perfect. No, Bhavya, call option underlying is dropping from 165 to 160. Remember, the current price is at 165. So for you to take the entry, you are not going to take the entry at 165. You are going to take the entry when the stock drops down to 160.75. That's where the demand zone is. Correct? Okay. So as the stock drops down from 165 to 160.75, the call premium of 155 will also drop down in value, isn't it? So once the stock hits the demand zone, you are buying further cheaper call. So your cost of acquisition becomes lower. Is everybody with me on this? Perfect. Okay. And what is going to happen at the demand zone? What do you expect the stock to do at the demand zone? Stock to move up, right? So you buy at the demand zone, the stock will start moving up again. So when the stock starts going up again, the cheaper call option that you bought, what is going to happen to that call option? Now that will start moving up, thereby giving you the profits, isn't it? Correct, Rahul. And even time value can increase depending on where it is and what are the market conditions. But definitely, intrinsic value will move up. So clear how we make money using options? So we trade only the premiums. So we buy cheap premiums and then sell them when they become expensive at our target. This is how we apply the options strategy instead of a stock. But the underlying stock is what decides when to enter and when to exit and what is the direction. Is this example clear? Any doubts on this in this example? Perfect. Let's go to the next example now. The next example is buying puts as supply. So the first one is a long call. This one is a long put. Buying calls at puts at supply. Now here, this is your supply zone from 745.50 to 755.20, and let's say 700 is your target. Now the considerations are the script is in a downtrend in the larger time frames. There is a quality supply zone. There is a quality supply zone which you would like to use and lean against to enter a bearish position. So in case of a stock or a futures, what you would have done? Sold short at 745, right? Perfect. So instead of doing that, we are going to make use of options now. Now the other rule is, the other assumption is general public is in calm mode, no news, therefore options premium are deflated. When I say options premium are deflated means what? They are cheaper. Correct. The options premium are cheaper. Now we want to use options as substitute for script when the stock enters the supply zone at 745.60. Now this trade is buy the 760 put option when the stock hits 745. Again, do not ask me why did you choose 760. We will do that later on. So once the stock hits 745.60, what we are going to do is we are going to buy the 760 put option. Okay, now let's look at the logic. How are puts correlated to the underlying? Inversely or negatively correlated. So which means now the stock is going to has to move up to hit that supply. What is going to happen to the 760 put option in that case? It will reduce in value. So once the stock hits the supply zone, the put premium will reduce and you buy a reduced put option. And at supply zone, what do you expect the stock to do? go down. So as the stock starts dropping down, what is going to happen to the put option? It will start moving up, thereby you will get your profits. Understood? Ramesh ji, Suresh, Ramesh, put up it. Yes, Puru. Because you're buying options, you have to go 90 days. I told you, right? I will not. Let's not ask about the 150. Why the 150 for 760? There is a rule. There are slides to choose how to decide to choose the strike. I'll come to that later on. No problem. All right. So is that correct? Is that understood, everyone? Strike price decision will be always based on the supply demand. Remember this. Where you have supply and where you have demand. That will decide your strike price. That's the only information that you need to know as of now. Tomorrow we will cover all the other aspects in detail. Don't worry. Let's go. Selling puts at demand. Now, at demand, you can either create a bullish position by either buying a call option, or what is the other strategy that you can use? Selling a put option. Now let's take an example of the same demand zone as the first example where we had bought the 155 call. We will see it using the put option. Now the script, oh sorry, the script is in an uptrend in the larger time frame. There is a quality demand zone that we want to use and lean against the to enter a bullish position. Now, the only change in the market condition is general public is in panic mode, that is earnings or some news event or election or whatever, and therefore options premiums are inflated. Inflated means expensive. Okay. And remember, our rule in trading is buy cheap, sell high, or sell high and then buy cheap, isn't it? You to always buy cheap and then sell high, or sell high and then buy it back cheap. That's the basic premise under which we operate. No, I'm not completed, Bhavya. So the script is in an uptrend in the larger time frame. The same example as the first one, buy call. Just that the condition that is changed is general public is in panic mode, that is earnings or any news event coming in, and therefore options premiums are inflated. How to figure out inflation, deflation will come once we understand volatility analysis. Okay. Now, as the stock drops down to the demand zone, now what we are going to do is we are going to use puts instead of the call option. Okay. So as the stock drops down into the demand zone, how are puts correlated to the underlying? Negative. So underlying drops, put will go up in value or come down in value. The puts will increase. Correct. So the logic is, as the stocks drop down to your demand zone, your put premium is going to go up. So when the stock hits the demand zone, you will have the optimum put value which you're going to sell. So you're selling something that has become expensive, isn't it? Now at the demand zone, what is the script likely to do? Bounce up. So once it is going up, what is happening to the put option? When stock is moving up, put will move down, thereby giving you your profits. Understood? Simple, isn't it? All right, perfect. Pudupet, M. Chandra, do you have any questions? I see you guys are typing. I am now to answer your question, Pudupet. I have told you right now, only focus on an example with whatever stress I am giving. How to define what is called premium high and everything will come later on. Okay. Yes, because why will M Chandra the put price will be high at demand zone because the general public is in panic mode and options premiums are inflated, and as the stock drops down your premium will also start moving up. Now the last example is selling calls at supply. At supply you can either buy a put option or sell a call option, right? Similarly, just let's take the same example where we had bought put. Instead of buying put, we will now sell call. Why we will sell call? The conditions, the supply demand conditions are still the same. The script is in a downtrend in the larger time frames. There is a quality supply zone that we would like to lean against to enter a bullish position. General public is in panic mode now. It is this reason, panic mode, and therefore options premium are inflated, that we decide to sell a call instead of buying a put option. Okay, so the action is, as the stock rises into your supply zone, you will sell a 760 call. So once the stock starts moving up, what is going to happen to your 760 call option? Increase in value. So once it comes to the supply zone, you will have the optimum call option value which you will sell, and at supply what is the script likely to do? Go down, and when it goes down, what is going to happen to your call option premium? Will that also go down? Yes, and that's how you will make your profit. Is that clear, everyone? Perfect. So that was what was remaining from yesterday's topic, which I realized. Now we have completed those. All right, let's go to the next topic now. Any questions, guys? Stop loss is always going to be based on your underlying script trade. So whatever your entry stop target is on the underlying, you will use that. Not necessarily, because these are swing trades, right, Ashish? Okay. Let's get into more details about the options premium. All of you just go through this slide. And once done, just let me know. Time value and time are correlated. More the time, more the time value. No, Bhavya. In calculation, does not affect. Okay, so we are looking at in the intrinsic value is only affected by a change in the price of the underlying. That is, as the underlying keeps on moving up and down, your intrinsic value will keep on changing up and down, and it does not waste away or decay. It always is a real value. Okay, it will only change if the underlying moves, otherwise it will remain as it is. Whereas the time value component is a wasting portion of the options premium. Now, what does the time value tell you? What are people expecting? And that expectation is built in terms of time value. It is a wasting portion of the options premium. It decays and becomes zero at expiry. It becomes zero at expiry. That is the inherent characteristic. Just go through this example. Pretty straightforward, then I'll explain it to you. I'll give you a couple of minutes to go through this example. Yeah, this is an in the money call example. Pudupet. Okay. No, 2 months has significance because more the time, what is going to be with more? Intrinsic value or time value? Time value, guys. Time value and time are correlated. More the time, more the time value. No, Bhavya. In calculation, does not affect. Okay, so we are looking at in the money call example. Yeah, people are expecting the underlying to move up in the next 2 months. That's what people are expecting. And remember, it is really not necessary that whatever people expect happens. Finally, our supply demand will tell us what is going to happen. So the call premium is at 36 rupees 40 paise. The strike price we're talking about is 780. The expiry is 2 months from now. The script price is 782.60. So intrinsic value is current market price minus the strike price. The strike price is 780. Current market price is 782.60. Correct, Samshuddin. The intrinsic value is going to be 2 rupees 60 paise, and whatever is the remainder is going to be your time value. So in this option, if you see, there is very little intrinsic value and very high time value component. So if the scrip remains at 782.60 for the entire 2 months and does not move from there, that 33.80, which is the time value, will anyways become zero, isn't it? Because it's a wasting asset. So what remains at the premium value is 2 rupees 60 paise, because the intrinsic value is something that is real. No, Anand, you will never get that. That is only deep in the money. First of all, ये लो प्रीमियम पे करने का, सस्ते में खरीदने का, ये सब अभी भूल जाओ. That is what you used to do when you did not know how to trade options. Now, when you know how to trade options, and even if you still keep doing the same mistakes, you're wasting your time and money, nothing else. Right now, I'm telling you, most of the trades, you are never going to buy options. Option buying is only allowed in Nifty. Yes, Shamsuddin. Finally, our supply demand will tell us what is going to happen. So the call premium is at 36 rupees 40 paise. The strike price we are talking about is 780. The expiry is 2 months from now. The scrip price is 782.60. So intrinsic value is current market price minus the strike price. The strike price is 780. Current market price is 782.60. Correct, Samshuddin. The intrinsic value is going to be 2 rupees 60 paise, and whatever is the remainder is going to be your time value. So in this option, if you see, there is very little intrinsic value and very high time value component. So if the scrip remains at 782.60 for the entire 2 months and does not move from there, that 33.80, which is the time value, will anyways become zero, isn't it? Because it's a wasting asset. So what remains at the premium value is 2 rupees 60 paise, because the intrinsic value is something that is real. No, Anand, you will never get that. That is only deep in the money. First of all, ये लो प्रीमियम पे करने का, सस्ते में खरीदने का, ये सब अभी भूल जाओ. That is what you used to do when you did not know how to trade options. Now, when you know how to trade options, and even if you still keep doing the same mistakes, you're wasting your time and money, nothing else. Right now, I'm telling you, most of the trades, you are never going to buy options. Option buying is only allowed in Nifty. Yes, Shamsuddin. Now, looking at this options premium, what do you think? Where is this option? Yeah, so it is close to the current market price. No, Ashish. So it is, isn't this is the at the money option? And at the money option always will have the greatest amount of time value. Remember that. At the money options will always have the greatest amount of time value. Is that clear? No, who said Anand? अरे ये टाइम वैल्यू और सप्लाई जोन का कोई लेना देना नहीं है यार. उल्टा सप्लाई दूर हो गया यहाँ से अभी. Yeah, that's okay, Rahul. That's because the my slides have those long-term wealth applications slides, which is not there in your in the latest manual. Okay, Arad. Arun and Shashank are typing. Let me see if they have any questions. Okay. Arun, do you have any question? Time value will decay and IV will increase with when script will increase. Correct. But see, add the money can be in the money or out of the money, right? Prasanna? This is technically an in the money option, but also it is at the money. So there are actually at expiry there are only two options: in the money or out of the money. There is nothing called as out of the money at expiry. At the money at expiry. Just that at the money is the strike that is closest to the current market price. Nothing else. Go through this example. In this, if you see, there is no intrinsic value. This is an out of the money call option example. There is no intrinsic value. Call premium is trading at 10 rupees. The strike is 840. Expiry is 2 months from now. Script price is rupees 782.60. Intrinsic value is 782 minus 840, which is a negative number. So negative number cannot be there. So what is going to be the intrinsic value? 0. Perfect. And time value is the premium minus intrinsic value, which is again 10 rupees. So everything here is 10 rupees. So if the stock does not change the entire period of 2 months, it stays at 782.60. The value of this option at expiry is going to be 0. Why? Because it only has time value, and then time value will decay and become 0 at expiry. The time value will then it can change. लाइक व्हाट एग्जांपल 782 से अगर तुम्हारा ये जो ऑप्शन है 840 स्टॉक प्राइस गोस टू लेट्स से 860 even if it goes to 800 840 is still going to be out of the money, right? So as long as the stock price remain below 840 at till expiry, it's only going to have time value component. Only when the stock starts moving beyond 840 is when you will have some intrinsic value associated with that. At 860, you will have 20 intrinsic value. Correct, Samshuddin. Read this in the money put example. Okay, so this is an in the money put example. The put premium is trading at 60 rupees. The strike price is 840. The current script price is 782.60. Expiry is 2 months from now. So intrinsic value is strike price minus current market price. For put options, remember it is strike price minus current market price, which is 840 minus 782.60 is equal to rupees 57.40. So 57.40 is the intrinsic value. Whatever is the remainder is going to be your time value, which is 60 minus 57.40, that is 2 rupees 60 paise. So if the script does not move till expiry, the value of this pre option at expiry is going to be 57 rupees 40 paise. Why? Because 57.40 is the intrinsic value, which does not decay. Time value is 2 rupees 40 paise, which probably would decay completely. Clear? Now looking at the intrinsic value and time value, can you tell me what kind of option we call this? Today we used a term. It is deep in the money. Absolutely correct. Remember, deep in the money options will have higher intrinsic value and very low time value. Okay? Everyone, is it clear to you? मार्केट हिल नहीं रहा है, उधर ही है, 35 पॉइंट्स प्लस है, इधर ध्यान दो. Yeah, so it doesn't matter. Even though because it is deep in the money, there is no time value. Expiry, see, the time value is also dependent on how deep or how close the option is to the current market price. Yeah, 60 rupees. So that's why I said, right? We never buy deep in the money options. You're buying expensive. This is as good as buying a futures contract. Now, this is the out of the money put example. Just take a look at this. Yes, Amit Kumar, go ahead. I understand that nearest strike price has more time value, but I checked one strike price on NSE where ATM and ATM has similar time value. Hey, how can you use different P's? Yeah, the price is 321. So let's use 320. The 320 call option is trading at 9.75 and the 320 put option is trading at 9.30. Pretty much similar. One is going to be slightly in the money, the other one is going to be slightly out of the money. There's nothing. See, it's not necessary that the time value has to be same. It also depends on people's perception as to what is going to happen to the stock. So if the stock, people are expecting the stock to move up, they are willing to pay more to buy the stock and less to sell the stock. That's why you will see a little bit more time value in call option than put option. It also depends on the overall trend of the stock. But we do not bother about these differences. They don't make any sense. All right, Amit? Welcome. So this is the example of a, where did this go? Okay. This is an example of out of the money put option with no intrinsic value. The put premium is 13 rupees 20 paise. The put premium is trading at 13 rupees 20 paise. The strike price is 760. The expiry is 2 months from now. Scrip price is rupees 782.60. Now, since intrinsic value for a put option is strike price minus the current market price. Since this is negative, there is no intrinsic value. So, intrinsic value becomes 0. And whatever premium is there is going to be the time value component, and if the script does not change for the next 2 months, the time value will become 0 and the premium of this stock will this option will also be 0. All right, are we clear with this? Perfect. Now see, basically now the two components of premium are intrinsic value and time value. Time value is also known as extrinsic value, by the way. Okay, time value is also known as extrinsic value. Now two components. Now how is intrinsic value affected, and what affects intrinsic value? The underlying script price. Okay, correct, Rameshji. So and how do you control that? Hey, why you cannot control that? I mean, control in sense not that everything. No, 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 no. Yeah, Kapil, hold on. Let me just finish with this question. How do we control the and absolutely correct, Rahul. Using demand supply, right? Demand supply will tell you where the stock is going to move and what is going to happen. So you can fairly have an idea of the intrinsic value component as it starts moving from your demand zone to your supply zone, or vice versa from your supply to your demand. Correct? So intrinsic value is managed now properly. You can govern in how to manage intrinsic value. Everyone? Perfect. Okay, Kapil, go ahead with your question in the last slide. What question you had? Yes, correct. That's the formula. Yes, you are right. Do you have any questions on that? Or it was just a confirmation that this is how it is? Yes, of course. So for call is different and put it is different. For call, it is current market price minus strike price. For put, it is strike price minus current market price. That's it. सडनली निफ्टी क्या 15 पॉइंट मूव किया, सब लोग शांत हो गए. If the price after 2 months, correct. After that, you will start having profits, Suresh. Yes, Girish. So the first step is you identify a core strategy setup, and then you do the options analysis. That's how the options trading is done. Very good, Shashank. So in fact, today you should not trade. Today is a time when let the market do what it is doing. So today, if market close on high, you should look for bullish positions from tomorrow onwards. Short-term trades from tomorrow. Because then there is enough room for Nifty to move up another 150 odd points. And even Bank Nifty. Okay. Now comes, so intrinsic value is taken care of and we don't have to worry about intrinsic value. All right. Okay, I have no idea what BFF, Nifty BFF strategy. But this isn't a breakout. It's just a reaction. So breakouts are different. Volatility is in section 4. So I would prefer to get into a bull put spread. Nevertheless. So are you guys clear about the intrinsic value and how to manage that? Yes. Now let's take a look at now from now on, the entire focus is going to be on this thing called as time value. Yes, Prasanna, go ahead. See, right, today we are on track because after this we are going to break for lunch. And then we will do time. Go ahead, Prasanna. Expiry and the zones, there is no correlation. There is absolutely no correlation between expiry and the zones. So forget that. Invalid question. Remember, you have to first find zones and then decide your option strategy. There's a lot of stuff that needs to be done. You feel it is complicated, right? As long as it's only left to your feeling, it's fine, Santosh. It is not, really complicated. It needs more time. It needs more time. कोर स्ट्रेटेजी तो बहुत इजी है ना संतोष जी? You have a very smiling face. आप जो बोल रहे हो ना कोर स्ट्रेटेजी इज वेरी इजी, पहले तो आपके कोर स्ट्रेटेजी के 1000 गलतियां निकाल सकता हूं मैं. No, Anand. Incorrect. At least 6 months. That too if you follow all the rules, which is not possible in the first 3 months. Because पहले 3 महीने में सब लोग घोड़े पे आते हैं पैसे बनाने के लिए. घोड़ा तुमको कब नीचे उतार दिया तुमको पता भी नहीं चलेगा. Yes, funny. So simple, Renuka. Monthly income trade में what are your execution time frames? Your execution time frame is daily, so your options trade will be executed on the daily zone. Weekly income time frame is 125 minutes, so you will execute 125 weekly income options trade on 125 minutes. At an expert level, not more than 1.5 to 2 hours. Anand, good things take time. You know, if it was that easy, everybody would be minting money by now, right? You wouldn't be in this class. So trading is fruitful, it gives time. No, it's not getting complex. Probably you're not doing the right way. So Sony, so still losing in cash, that's fine, Suraj. As long as you're making sure that your risk is very, very small, nominal, you will be fine. Don't worry about that. It's not hardly. I think you might have done your core strategy only in January, right? Last month. Because I guess you signed up in December when I had come to Bangalore. Yeah, so don't worry. You have to give yourself good 6 months, and in those 6 months, you will perfect your option study. That's how it has to go. I'll tell you how to do it on the last day. How to go ahead with your options career. Don't worry about that. I'll guide you everywhere. At every point in time, I'm there to guide you. As long as I'm there with OTA. Yeah, then don't take those previous day entries because they might be valid only for that day. Yes, Sony, go ahead. What is your question? We look for option. I answered that question, Sony, on a daily basis. Yeah. So basically, you keep on planning your trades on the underlying. You keep on planning your trades in the underlying. And as you get good trades in the optionable stocks, you just plan your see whether an options trade will make sense there. If it is there, then prefer to take the options trade rather than the futures trade. Especially if it's a credit strategy, I would prefer to take the credit strategy. Are you planning to leave OT? अरे क्या यार ऐसे अफवाह मत फैलाओ. Everything has a shelf life. Remember, Arun. तो मेरा भी OT में एक shelf life होगा. तो जब तक हूं तब तक फायदा कर लो। How do you know my Pimple Nilak address, Omkar? Ah, you stay in Pimple Sodagar, right? I know, I know. All right. Now, so intrinsic value is taken care of. Let me just finish these two slides and then we'll break for lunch. Now, the time value component is always affected. Yeah, expiry मार्च भी हो सकता है भाई, अप्रैल भी हो सकता है, मई भी हो सकता है. Just give me a moment, guys. आप लोगों ने आनंद पिक्चर देखा क्या? आनंद पिक्चर, उसमें एक उसका डायलॉग होता है, जापना जिंदगी एक रंगमंच की कठपुतलियां है, रंगमंच है और हम इस रंगमंच के कठपुतलियां है, कब किसकी डोर खींची जाए ये कोई नहीं जानता. हा हा हा. दैट वे बाबू मोशाय. So, कब मेरी डोर खींच जाएगी मैं नहीं जानता. ओटीए से, जिंदगी से नहीं. Yeah, I'm a movie buff and a sports buff, so that's why in a lot of especially core strategy, um, you see I give a lot of analogies with movies and cricket. I could do better as in with politics, but then वो थोड़ा uh, थोड़ा political हो जाएगा इसलिए नहीं करता. Can you do sports trading in India? Yeah, maybe you can. Okay, now let's take a look at this point. So time value is affected by interest rate, the cost of holding the underlying to expiry. Okay, interest rate has some effect on the time value component of an option, because what does an option give you? It gives you a right to buy or right to sell, right? So you're trying to control an asset on a future date, so there is going to be cost. You will have to have those funds if you want to have right to buy, and that is going to affect the interest rate, is going to affect the cost of funds. So that's why interest rate has certain impact on the time value component, but it is minimalistic. Underlying price, as the underlying price keeps on moving up and down, that is also going to affect your time value component. Why? Because as the underlying keeps on moving, people's expectation will keep on changing, and as their expectations will keep on changing, the time value will keep on inflating and deflating. That's number two. The number three, strike price. Whether you are choosing an at the money, in the money, out of the money strike price, the time value component will differ for each of these strikes, isn't it? Yes. The next is time to expiry. The number of days until the end of an options contract life. And especially the time to expiry, isn't it a direct correlation with the time value? Call or put. Calls are differently priced, puts are differently priced. Fear and dividends make calls and puts to be priced differently. So when there is more fear, what is going to impact more? Puts or calls? No, when there is fear, people will rush to buy put options, right? When there is, yeah, exactly. And when there is a bullish market and a momentum is strong in the uptrend, people will rush to buy call options at any price because everybody thinks that markets are just going to go up. So then calls will be priced differently based on the trend. And the last is the volatility, which is expectation of future price movement, which is what people are thinking. अरे ये आगे जाएगा, ये ऊपर जाएगा, ये now everybody might be thinking निफ्टी भाग जाएगा ऊपर because आज फर्स्ट टाइम 6 दिन के बाद पॉजिटिव दिखा रहा है and if it closes let's say stronger today, everybody tomorrow will rush to buy call options. Volatility will change, isn't it? And when I say everybody, I'm talking about the novices, not people like us. People like us would have already got into the call option trade today or yesterday. Yesterday would have been the right time to enter into bullish, but then it would have been a risky trade. Why? Because the trend was against you. Yes, both Nifty, Bank Nifty, they're forming good demand zones. Okay. So, in this now, let's talk about what can be easily controlled and what cannot be. Okay. Now, interest rate. How often does interest rate change in India? We are talking about the RBI interest rates. How often does this change? No, the cycle, the policy decisions are done every quarter, but have you ever seen every quarter the interest rate changing? No. Yeah. So pretty much, what is the probability that when you are in an options trade, the interest rate is changed? What is the probability? Low or high? Low. So it does not. So can we consider the interest rate as a variable or a what do you call it? Fixed component which can be managed? Perfect, fixed. Underlying price, is it fixed or variable? Variable, constant, dynamic, changing every second. It keeps on changing. So interest rate is fixed. Underlying price is dynamic or variable. Strike price, a 640 strike price, will it change on its own? So strikes are fixed. Time to expiry. Okay, is time to expiry fixed or changing? So you know that it's a standard rate, right? Standard rate. A month has 30 days approximately, and then each day has 24 hours. So you can measure this correctly, isn't it? So time to expiry is also fixed. What about call or put? Will a call change to put or a put change to call? Again, call or put. A 640 call will always be a 640 call till its expiry. A 540 put will always be a 540 put till its expiry. So this is also fixed. People's expectation, that is volatility, is it fixed or variable? Extremely variable, right? I mean, what you think today and what you will think 1 hour later is going to be drastically different, isn't it? So when you see this time value component, even though it is affected by interest rate, strike price, time to expiry, call or put, they are more or less fixed variables. And the only two variables, parameters which are variable are the underlying price, which constantly keeps on moving, and people's expectation, which is nothing but the volatility. Isn't it? How do we control underlying price? Demand zone, supply zone. Absolutely correct. So which means अभी ये underlying price भी आपको पता है कैसे control करना है? Yes or no? Yeah, we are only going to manage it by having proper supply demand equation, right? Yeah, more or less. So what remains in this whole thing is, for you as an options trader, is the broader understanding of how to control volatility, because this is the only thing that is the most important thing for an options trader: volatility. And from now on, everything is focused on volatility and time value. So after lunch, we are going to start with time value, volatility. Okay, any questions? Yes, that's when the Greeks will also come. After volatility, it's the Greeks. Dhirendra ji, 1330 क्या है? Suraj, yes, underlying price is how can you control the underlying price movement? By using supply and demand, right? At demand, prices are going to move up. At supply, prices are going to move down. Got it, Suresh? Mr. Suresh? No, no, nothing to do with the location of the current price. Just hold on. Don't think too much. Don't think advance. You're trying to think from a trade perspective or the stock price perspective. It's incorrect. Do not think like that. Right now, just understand this. Because it affects the time value. So why will we not give you? Ramesh ji, underlying price does affect the time value component. So everything that affects the time value component needs to be controlled, isn't it? Okay. Dhirendra ji, what time? 2 o'clock. We come at 2 o'clock. 1 hour lunch break. तब तक निफ्टी 100 पॉइंट्स प्लस हो जाएगा. Not in this class, Anand. Next Wednesday I have a stock XLT. You can ask me that time. All right. Yeah. Now everybody log out of the room. Just log out and log back in at 2 o'clock. All right. I'm going to close the recording. Stop the recording and close the room. Everybody log back in at